Okay, so we're going to take Fernando first. And Fernando's question is, with the PowerOptions tool, how can I find a spread with a very low risk-reward ratio? All right. Now, you didn't say what kind of spread, Fernando, so it depends what kind of sentiment you have. It depends what kind of direction you're looking for. But leading into Stephen and Jesus's question a little bit, and you say you're bullish, let's just take this idea. I had a great conversation during a coaching session this week on the same topic. I'm just going to go back to bull put credit spreads. And you know what I'm going to do. I'm going to start with my weekly bull puts that I like. Now, I'm going to take a middle of the road one, Fernando. And, you know, the top one here is where I want to be. That's right in the wheelhouse I want to look for: 16, 16, 14.9, 13.6. I'm going to go a little bit lower. I'll use AbbVie. Why not? Not a recommendation or suggestion again. Stocks at 109, 2-week out spread, selling the 103 put, buying the 101, net credit of 21 cents on a 2-point spread. So we're risking 179 to make 21 cents. Essentially an 8-to-1, almost 9-to-1 risk-reward ratio. Again, as we talked about before, if this was an iron condor that we just sort of discussed instead of a short strangle, this would be the bull put side. I have a known risk of $1.79 and a $2 margin requirement. I'm only taking in 21 cents. Let's call it a 9-to-1 risk-reward ratio. It's close enough. How can I get a lower risk in this scenario? Well, there's 3 ways to do it. What is the risk? The risk is the monetary risk, which is the difference in strike prices minus the net credit. How can I keep a 2-point strike difference but get a lower monetary risk? Well, I can't go closer in time with the same strikes, 103 and 101, because that would be a lower premium. I can go further out in time, keep the 103 and the 101, and go 30 days out, 60 days out, 49 days out, and I'd get a higher net credit. But now I'm waiting 4 times, 5 times the length to get close to that expiration. It was 49 days away. So about, 4 times, 5 times away. Now, the answer to this, if I was keeping the same expiration, Fernando, and I wanted a better risk reward, is I have to go closer to at the money. I'm probably looking at the 106, 104 strike for October 14th. See, we did the 103 at about 62 cents and looked at the 101 at about 42 cents for that 21-cent net credit. I go to the 106 at 122 and the 104 for about 77, 78 cents. I'm going to get a 50-cent net credit. Close to it, 48, 51-cent net credit. Yeah, 49.50 with that extraneous price in there. Let's take that out and go down to just 49. So what now? Well, my risk is 151 to 49. It's a 3-to-1 risk-reward ratio. But what did I want? I wanted what was in my wheelhouse, Fernando, a bull put credit spread where I had an 85% probability or higher. To get a lower risk on a bull put credit spread, a 2-to-1, unlikely, 3-to-1, which is where we are now, looking to make 49 cents with risking $1.50, this 106 strike probably only has, I'm going to guess here without even looking, probably only has a delta or probability of around 65%. Let's see. Probability, okay, 71. It's much higher than I thought. 71.5% probability. But I'm at a 3-to-1 risk-reward ratio now on the position, making 49 cents to risk $1.50, or 50 cents to risk $1.50. But I'm taking a much lower probability closer to the current stock price for that risk. If you want to see a lower risk-reward ratio, the net credit versus the monetary risk, or the net credit, or difference in strike prices minus the net credit, you've got to go less out of the money and with a lower probability. And Fernando says it is okay to have a lower probability. If that's your assessment and that's what you want to go with because you trust your research and you trust the stocks, yes. As you've heard me say before, all of the analysis I've done shows that doing bull put credit spreads consistently with a probability between 70 and 75%, even in up market conditions, but over time when the market fluctuates, we're not successful. 75 to 80 was a small profit, but nowhere near the targets. 80 to 85 was pretty good. The best return came out to be around between 85% probability and higher, 85 to like 92 in those cases. So long-term, continuing to use a strategy, that's what I look for. If you feel the market has bottomed and it's going to recover in the next 10, 12, 15, 20, 30 days, you feel it's going to be bullish and it's okay to take the lower probability on the position because you expect the market to recover and move up, that's a chance that you're willing to take, and that's great. But that's how you get the lower risk reward. Let's stick with AbbVie again. And we're going to change. We're going to still talk about bull puts for a moment. We're going to still talk to Fernando, but we're going to change gears very slightly. We had moved up to the 106, same expiration, 14 days out, 106, 104 strike, net credit of roughly 50 cents for a risk of 150, 3-to-1 risk-reward ratio. Can I get a 1-to-1 risk-reward ratio? Sorry about that, Fernando. Can I get a 1-to-1 risk-reward ratio with a bull put credit spread? The answer is yes, but it's not something that investors would do on a regular basis. What do I mean by that? A 1-to-1 risk-reward ratio on a credit or debit spread is typically right at the money or just out of the money. And this one's close. That one's almost closer. Okay, I'm going to use the 109, 107. I'm going to keep 2-point strike difference here. All right, so we're going to do the 109 right at the money, 107. So I'm taking in a net credit of 101. I'm sorry, let me expand our profit and loss chart here. We're taking in a net credit of 101. That means my risk is 99, so I'm right at a 1-to-1 risk-reward ratio. Why don't investors do this, whether it's 10 days out, 14 days out, 30 days out? Because this is a bull put. Fernando, what is this here? This is an obligation to potentially buy shares of stock. Doesn't matter if you're in a spread. That obligation of the sold put does not change. I'm still obligated to buy 100 shares of AbbVie at 109 if the stock falls to 108.50, 108.50, 108, 107.50, and at 107 I'm at the maximum loss. Okay? Most investors who are trading the bull puts are trading them like me, meaning that we're looking to do 3 to 4 trades every week, 2 weeks, or 3 weeks to look for the high probability of expiring worthless with management techniques in mind, because I don't want to take a 100% loss on the position. But my goal is also not to buy shares of stock. And that is a potential outcome of this position if it falls below the short put. Yes, I can manage it, but if there's a sudden gap down, it moves up to say 111, then suddenly gaps down to 108, and I'm assigned early, I got to buy that stock. I can still be early assigned. So most investors we talk to on a regular basis will not do this 1-to-1 ratio that has only about a 48 to 52% probability of being above 109 14 days from now because of the obligation they may end up potentially buying shares of stock. We've talked about this. I know you've been online here before, Fernando. The approach an investor might use to do a bullish strategy where they want the lower risk-reward ratio without the potential obligation of having to buy shares of stock and put up the capital to do it without being covered is we're not going to do the bull put credit spread. We're going to do the bull call debit spread, an at or out of the money bull call debit spread. So we're going to stick with 14 days. Now I'm going to sell the 109 call, same as the put. And I'm going to buy the deeper in the money 107 call. It's going to give us the exact same risk reward profile, Fernando. Stock's above 109, we make the maximum profit. The stock, oh, sorry, folks, the stock falls above. Stock drops below 107. We have the maximum loss on the position. Let me clean that up a little bit. There we go. That's better. Now, this had a debit of 123 at midpoint, but we're looking to make $77 at a 123 as long as the stock stays above 109. Why is this important? Well, I had mentioned that you don't want to buy shares of stock or risk early assignment. And you said, so I could mount the spread OTM. Well, if you mount the spread OTM and go further out of the money, you're at that 3-to-1, 5-to-1, 6-to-1 risk reward ratio. That's the definition of an out of the money spread, Fernando. That doesn't change. You got to go closer to at the money to get the 1-to-1 or 2-to-1 risk reward ratio you want. That's the trade-off. You've got to take lower probability to get those lower ratios. It's not about stock selection. It's just about the nature of the spreads and the nature of options themselves. Okay. I am still in a sold call here, which may require me to deliver shares of stock if the stock is above 109. I just said that, most people wouldn't do this at the money spread with a bull put credit spread because of the risk of assignment. I can still be assigned here, but this is a debit spread. I own the right to buy it at 107 at a lower price to deliver at 109, and that gives me my maximum profit. That's safer because even if I'm assigned early, my broker would exercise this long to deliver the short. I'm out at max profit. In the bull put, if the stock fell between the strike prices, I can be assigned early on the short put and be forced to buy stock. In the bull call, that call is just out of the money. No one's going to sign me on it. Yeah, my long call is losing money and I'm losing money on the position, but I can't be forced assigned. So the 2-to-1, 1-to-1 risk reward approach, bullish, short-term or long-term, is typically done with the debit spreads. The most common approach we've heard over the last 2 to 3 years from investors on our webinars and other educators out there that promote this idea is to do a bull call debit spread that's maybe 35, 40, maybe 60 days out in time and sort of straddle the stock price. Use a 105, 100 here. I'm sorry. Buy a 105 call 49 days out, sell a 110. Bull call debit spread. Debit of 272 with the potential to make 5 points maximum profit back. Maximum profit of 228, close to a 1-to-1 risk reward ratio. But what they're going to do is if the stock moves up as they're expecting, if they can liquidate the position in the first 10, 15, or 20 days for $114 of profit, take 50% of the expected profit off the table early without waiting 49 days for the maximum profit, they'll usually go ahead and do that. It's not something I do on a regular basis, but it does appear to be the preferred approach because the short call is out of the money or just at the money. You don't have to worry about being early assigned on this structure as you do with the bull put credit spread. And if you are early assigned, you have the call. You've bought that call in the debit spread, so your broker would exercise the 105 to deliver the 110. You don't have to put up the capital or risk being short shares of stock on the position. Okay, so real quick, while we're on this approach here, let me go back to just the AbbVie bull put. There we go. So I know I said I was going to talk to Jesus, and I am. And I know I said we're going to cover up and show Stephen how to do his search. I'm going to go back to the AbbVie position. Salvatore says the bull put credit spread screener has had five. Oh, F5, sorry, I thought you meant 5 spreads with an 85. He said, had 5 as an 85% probability play. I was tempted to put in 30 contracts on the 145, 140, November 19 with an 8.7. Okay, so you're going out to November. You're not doing shorter term. Let me just build this one. And I think it's different now, but let's look at 5. This goes with the bull put credit spread topic. It's important. It's not something that I bother to look at. I understand Salvatore's question. It's not something that I look at or Ernie looks at. I understand the concern about it, but we're going to talk about that concern a little bit more too. But let's go to Salvatore's quick question here. And 5 is an 85% probability selling the 145, 140 November 19 with an 8.7% return. Okay, and so the 145, oh, it's still there, good. 145, 140, although the prices are going to be a little bit different. Okay, a maximum risk on the 5-point spread. But I wanted to do, and I was tempted to put in 30 contracts of this position. Okay, so I'm sorry, the question sort of jumped around and I missed that, so that's why I'm stumbling and I apologize. Let's just put this in here. You said an 8.7, there it is, it's about the same. All right, so here we go. 85% probability for November 19th, 8.7% return, $1,200 maximum profit against a $15,000 monetary requirement or margin requirement on the position. But I quickly realized the enormity of funds needed if assigned. The profit and loss calculator doesn't display it and makes very tempting on the surface. But you said, is the underlying, doesn't take, very tempting, is the underlying stock risk calculated somewhere else? No. One of the main reasons why is that, yes, anything can happen and the position can fall. We're going to talk about that in just a moment. But our rule of approach and our general rules is that unless the stock is declining, and suddenly gaps down, you're going to look to manage or exit this position if the stock reaches to within 1 or 1.5% of the short put strike price. We don't let it go in the money to be assigned. Now, very quickly, if you wanted to analyze what the monetary risk would be on this position if you were assigned early on your 30 contracts, it doesn't do that in the search. Just clear out the long put, Salvatore. There you've got the monetary requirement, the 145 naked put or cash secured put position, and what it would cost to buy your 30 contracts at 145 strike. Which brings up another point. Remember, of course, I don't know your portfolio size, Salvatore. I don't need to know it. I'm not your CPA. I'm not a financial advisor. But if the 30 contract position on this case, just because it's bringing in a big premium, you know what we always recommend, in addition to closing it out, if possible, before the stock hits the short put strike price, which reaches within 1 or 1.5%, so it doesn't go in the money. If this monetary requirement on one single trade should probably not represent more than 3 to 5% of your total portfolio. And the bull put credit spread exposure, if you're doing 3 positions of this size, that total $45,000, of course, should not represent more than 15 to 20% of your portfolio, because those positions can go against you. And when they do go against you, you get into slight trouble, as we saw. Okay, so the next earnings is unconfirmed. They must have recently had earnings. I was worried that they might have had earnings between now and expiration, and you weren't filtering for that, but they haven't released when their earnings date is. It's hopefully likely after the 19th, as you mentioned, for November, and in that case, that would be there. But if you were concerned about seeing what the monetary cost would be, from the search, link to the profit and loss chart. Analyze this as you would to evaluate what your total cost net credit would be, the return would be for your goals with a high 85% probability, and the monetary requirement on the position. And then if you wanted to see what the potential obligation would be, cash secured wise, if you were put the stock early, you let it drop below to 142, 143, and you were signed, just clear out the long put, and you're evaluating it as a cash secured naked put. Right? Early assignment typically doesn't happen that often in these situations. It can happen, though, and that's always important to remember. You have to always be aware of the rights and obligations, as we mentioned before when discussing that other strategy. So in this case, that's how I would do it to evaluate that monetary amount.